The wrong financial habits in your 20s, 30s, 40s, and 50s don't just set you back, they can cost you your retirement, your freedom, and your peace of mind. Imagine making six figures, but still being broke, stressed, and unsure about the few in this video. We'll break down the 14 most damaging financial mistakes adults make and exactly how to avoid them, whether you are in your 20s, 30s, 40s, or even 50s. These strategies could change your life. That is the silent trap millions fall into, not from lack of income, but from money mistakes they never saw coming. Mistake number 1, not building an emergency fund. Think of your emergency fund as your personal financial airbag. Life throws unexpected punches: medical bills, job loss, sudden car breakdowns. If you're not prepared, you will end up pulling money from investments, racking up high-interest debt, or worse, halting your financial momentum. Financial experts recommend 3 to 6 months of expenses in a liquid account, but if you self-employed or in a volatile industry, aim for 6 to 12. Start with a $1,000 target, then build from there. Don't mix this money with your checking account. Use a high-yield savings account so it's separate, safe, and growing. Automate transfers. Even $50 per week compounds over time. Use windfalls like tax refunds or bonuses to fast-track it. The key: treat your emergency fund as a non-negotiable bill. Here's where people go wrong. They dip into it for vacations or small purchases. Stop that. It's not your fun fund, it's your lifeline. Buffett famously said, "Predicting rain doesn't count, building arcs does." This fund is your ark. Without it, every financial setback becomes a crisis. Visualize it like a seatbelt. You don't need it until you really do. And then, it might be the only thing that saves you. Mistake number 2, overspending on housing. Your home should be your haven, not your financial trap. But many people in their 30s and 40s fall into the status trap, buying or renting more house than they can truly afford. Just because a lender approves you for a higher mortgage doesn't mean you should max it out. The real rule: keep total housing costs, mortgage or rent, property taxes, insurance, and maintenance under 30% of your gross income. Say you earn $6,000 a month, your housing shouldn't exceed $1,800. This leaves room for retirement savings, emergency funds, and living. Overspending here is the #1 reason people can't build wealth. It locks up cash flow that should be working for you elsewhere. Before buying, get pre-approved for a reasonable budget, not your dream house number. Account for hidden costs, HOA fees, rising interest rates, future repairs. If renting, beware of lifestyle creep. That extra bedroom or fancy skyline view could delay your freedom by years. Warren Buffett still lives in the modest Omaha home he bought in 1958. Why? Because he values freedom over flash. You don't need to own a mansion to be happy, he said. Live below your means and you'll always have options. Home ownership shouldn't strangle your finances. Make space in your budget for life, not just your living space. Mistake number 3, ignoring retirement savings. Retirement feels far away until it's not. And the biggest mistake people in their 30s, 40s, and even 50s make: waiting too long to start. The earlier you begin, the less you need to save each month. That's the magic of compound interest. Let us compare someone saving $500 a month from age 30 to 65 at a 7% return ends up with $1.1 million. But wait until 40, and they must save over $1,200 a month to hit the same goal. That's a 140% increase in effort for a 10-year delay. Make it automatic. Max out your 401 match. It's free money. If you don't have access, open a Roth IRA. Can't contribute the max. Start with what you can and increase 1% each year. Market dips. Don't panic. Stay consistent. Time in the market beats timing the market. Set it, forget it, grow it. Here's what Buffett says. Someone's sitting in the shade today because someone planted a tree a long time ago. Start planting, not just saving for old age. You're buying freedom. The freedom to retire early, to take a sabbatical, to say no to a job you hate. Retirement savings isn't just about the future, it's the bridge to options. Your 60-year-old self is depending on your 30 or 40-year-old self. Don't let them down. Mistake number 4, carrying high-interest debt. High-interest debt is the silent killer of financial freedom. Credit cards with 20 to 25% APR aren't just inconvenient, they're devastating. If you carry a $5,000 balance on a 22% interest card and pay only minimums, you'll pay nearly double over time. Here's the trap. It starts with a small emergency, a shortfall, or even an impulsive purchase. But it builds, and the longer you let it sit, the harder it is to climb out. Warren Buffett's advice: if you're smart, you're going to make a lot of money without borrowing. That's because interest works both ways. It either works for you or against you. Adopt the strategy, the avalanche method. Pay off the highest interest debts first, the snowball method. Pay off the smallest first for momentum. Either one works, just commit. Avoid new debt, freeze the cards if you have to, cut them up. Go on a cash-only diet. Every dollar you throw at debt now is a dollar that can later build wealth. Balance transfers with 0% intro APR or consolidation loans can help, but only if you stop the bleeding. The goal isn't just to escape debt, it's to never fall back into it. Debt is the past stealing from your future. Reclaim your future one payment at a time. Mistake number 4, carrying high-interest debt. High-interest debt is the enemy of financial growth. Credit cards, personal loans, and buy no pay later schemes may feel manageable, but they quietly strangle your future. In your 20s, 30s, and 40s, the stakes are higher. The average credit card APR in 2025 is over 22%. Carry a $10,000 balance and you're paying more than $2,000 a year just in interest. That's money that could have gone toward investments, your emergency fund, or your kids' college. And yet, many people only make minimum payments. That's how the debt trap begins. Warren Buffett puts it bluntly: the chains of habit are too light to be felt until they are too heavy to be broken. If you're in this situation, don't panic. Try the avalanche method. Pay off the highest interest debts first, or the snowball method. Start with the smallest balances to build momentum. Consider balance transfers or a loan trust personal loan, but read the fine print. And most importantly, stop adding to the debt. Freeze cards if you must. Shift spending to cash or debit. Debt doesn't just cost you money, it costs peace, options, and sleep. Getting rid of it is the fastest path to financial breathing room. Mistake number 5, relying on one income stream in your 30s, 40s, and 50s. Relying on a single paycheck is a dangerous game. Layoffs happen, health issues arise, even companies collapse overnight. Yet most adults have just one income stream, their job. That's risky. Why put your entire financial future on one foundation? Warren Buffett built Berkshire Hathaway by diversifying, not betting everything on one horse. His advice: never depend on a single income. Make investment to create a second source. Start small. If you have a skill, turn it into freelance income. Write, design, tutor, consult. Even $200 a month adds up. Don't want to trade time for money? Explore passive income, dividend-paying stocks, reads digital products like ebooks or templates. Rent out a spare room or car. The goal isn't to hustle 24/7 stits to build resilience. Multiple income streams create options. Lose one, the others keep you afloat. Automate one stream, actively grow another. Over time, side income can surpass your job in command. That's when real freedom begins. Don't wait until disaster hits. Start planting seeds today. Your future self will thank you. Mistake number 6, falling for lifestyle inflation. You get a raise and suddenly you deserve that new car, bigger house, or luxury vacation. Welcome to lifestyle inflation, the quiet killer of wealth. The danger: every time your income rises, your spending does too. And if that continues, you'll always feel broke, no matter how much you make. Let's say your salary grows from $70,000 to $90,000. If you immediately upgrade your apartment, wardrobe, and dining habits, you've gained lifestyle but not freedom. Warren Buffett's warning rings true. If you buy things you don't need, soon you'll have to sell things you do. To beat lifestyle creep, set a rule. When income increases, save or invest at least half before touching the rest. Automate those deposits before the money hits your spending account. Another trick: lifestyle lock-in. Choose a modest lifestyle that gives you joy and stick with it even as your income climbs. The difference becomes wealth. Track your spending for a month. Identify wants disguised as needs. Ask, is this making me richer or just busier? You don't need to downgrade your life, just upgrade your mindset. Freedom isn't about more, it's about enough. Mistake number 7, Skipping insurance coverage. Most people don't think about insurance until disaster strikes, and by then, it's too late. Skipping proper insurance isn't just risky, it's financially reckless. In your 30s to 50s, you likely have dependents, a mortgage, and growing assets. A car crash, hospital stay, or a sudden illness can wipe out your savings in days. Warren Buffett once said, "Risk comes from not knowing what you're doing. Insurance is knowing. It's preparation. It's peace of mind." Start with health insurance. Even one night in a hospital can cost over $10,000. No coverage, that's a debt trap. Next, life insurance. If someone relies on your income, a simple term life policy is non-negotiable. A 35-year-old in good health might pay $30 a month for $500,000 in coverage. Then comes disability insurance, often ignored, but vital. If illness or injury prevents you from working, it replaces your paycheck. Think about that for a second. Also review renters or homeowners insurance, umbrella coverage, and auto insurance deductibles. Think of insurance not as an expense but as a barrier between you and bankruptcy. You insure your phone, you insure your car, why not insure your future? Mistake number 8, underinvesting outside retirement accounts. Many people believe that maxing out a 401 or IRA is the final step in wealth building, but relying only on retirement accounts limits your flexibility, and worse, it slows your journey to financial freedom. Here is why. Retirement accounts come with age restrictions, penalties for early withdrawal, and contribution caps. They are fantastic. But they are not enough if you want options before age 59, Warren Buffett said. Someone is sitting in the shade today because someone planted a tree a long time ago. But you don't plant just one tree, you grow a forest. Open a taxable brokerage account. These accounts have no age restrictions, allow you to access your money anytime, and offer endless investing options like index funds, ETFs, or dividend stocks. Let us say you invest just $200 a month in an S&P 500 index fund with a 7% return. That's over $200,000 in 30 years. Want more diversity? Explore REITs, fractional real estate platforms, or even digital income products like ebooks or YouTube content. Use robo-advisors if you're just starting. They automate the hard parts. Your 401 is your future, but your taxable investments can be your freedom fund. Don't stop with retirement accounts. Invest beyond them. Because wealth isn't just about retiring someday, it's about living with options today. Mistake number 9, ignoring career development. Your career is your #1 wealth building tool, and yet many people stop investing in it. They plateau, they coast. Meanwhile, their peers take certifications, build networks, switch industries, and double their income. Stagnation is costly. Let's say you earn $70,000 today. What if you could earn $90,000 next year with a $500 online course and 3 months of evening study? That's $20,000 annually for life. Buffett's golden rule. The best investment you can make is in yourself. Whether it's coding, design, sales, or management level up, take online courses, attend webinars, join LinkedIn groups, update your resume regularly, ask for raises, know your worth. Consider lateral moves to a teacher could pivot to instructional design or corporate training. A project manager might shift into tech. You don't need to quit, you need to evolve. The fastest path to wealth might be a better paying job. If you're not growing, you're falling behind. In today's market, skills pay the bills. Mistake number 10, not planning for life goals. Your 20s, 30s to 50s are filled with dreams, buying a home, raising kids, starting a business, retiring early, but goals without financial plans, just expensive wishes. Want to buy a $400,000 house in 5 years? That's $80,000 down. You'll need to save $1,333 per month. Dreaming of a $10,000 trip? That's $278 a month for 3 years. Break big goals into mini. Create separate savings accounts, automate deposits, use visual tools like progress bars to stay motivated. As Buffett says, an idiot with a plan can beat a genius without one. And meet with a financial planner. Even one session can create clarity. Financial freedom doesn't just happen, it's engineered. And the blueprint starts with planning. We just covered 10 of the most damaging financial mistakes adults make in their 30s, 40s, and 50s. These aren't just theories, they're traps real people fall into every day. But now you know better. Which one hit hardest? Let me know in the comments. And if you found value in even one of these strategies, hit that like button, subscribe, and turn on notifications. There's much more to come because mastering money isn't about luck, it's about learning the rules. And as Warren Buffett says, the more you learn, the more you earn. See you in the next video.